Hi, welcome to the episode 2 of my Money Masterclass. In the last episode, I talked about the importance of having personal finance management, focusing on the common financial mistakes we usually make, right? If you haven't watched it yet, do watch it. The link is in the description of this video in the YouTube. Today, let's explore the details of Public Provident Fund, commonly called as PPF. It is one of the most underrated and mismanaged asset class, and most people are not able to extract the maximum returns out of this investment where the returns are 100% tax free. So let's dig into this today. I'm also going to share with you the exact numbers, the exact amount you will have at the end of each year, which should take you or help you make an informed decision on whether to invest or not, when to invest, how much to invest, and how to invest. Just a standard disclaimer, mainly that this video presentation is for education purpose only and should not be treated as a substitute of any professional, personal financial advice which differs from person to person. So what is PPF? It's a long-term, tax-efficient, low-risk, Government of India-backed debt investment option with guaranteed returns. I will discuss each of these highlighted features of the PPF in next slides. So PPF scheme was launched by Government of India in 1968, mainly, because for even the non-salaried people to have an equivalent of Employees Provident Fund scheme, which is available for salaried class. There was nothing like that for non-salaried people. The key objective was to help the people build a good corpus over a long-term period, usually for post-retirement expenses, down payment to buy a house, child education, marriage expense, old age related medical expense, and any such large expenditure which may come up in future. As the returns are guaranteed by Government of India, it gives peace of mind to investors. Neither does it fluctuate like stocks or equity mutual fund, nor does it have any default risk. So let's look at the eligibility. Any Indian resident individual of any age can open a PPF account in a designated bank or post office. You can open it online too with a few banks. This is the easiest way to open it if you have a net banking facility with any bank for your saving account. A person can hold only one PPF account in their name, plus one more PPF account in the name of a minor child to whom he or she is a parent or legal guardian. If any person is detected to have two accounts, the second account will be closed and entire invested amount will be refunded without any interest. So don't try to act smart and open more than one account in your personal name. HUF and NRI cannot open a PPF account, and if a resident subsequently becomes an NRI during the prescribed term of 15 years or extended 5-year period, he or she may continue to subscribe to the fund till its maturity on a non-repatriation basis. That is, you will not take the funds out of India. You cannot open this as a joint account. It has to be single owned account. But nomination facility is available. Nominee can collect the balance but not deposit any amount in the PPF account. All right. So PPF actually is a debt scheme run by Government of India. So there is never any default risk. The returns are guaranteed by Government of India. But this has interest rate risk because the interest is not fixed for the whole tenure of 15 year. It is announced by Government of India on a quarterly basis. So it can go up or down. So there is an interest rate risk. But still, it's a preferred long-term investment option for people with low risk appetite seeking guaranteed returns. The minimum deposit you can have in the account is 500 per financial year, and maximum deposit you can have is 150,000 per financial year. You can deposit the amount in any number of installments. There's no restriction, or a lump sum too, in any mode, either by cash, check, DD, or online fund transfer. But yes, don't miss to deposit at least 500 rupees every year to keep the account active, because a penalty is levied um, if this minimum amount is not deposited in a financial year. The entire deposit amount is eligible for 100% deduction under 80C of Income Tax Act. Now look at the interest. As you see from the interest rate history of last 20 years, in the table here, the interest announced by Government of India fluctuates over a period. It can move up or down depending on the interest rate scenario or the economic condition. Currently, the rate of interest is 7.1% per annum as announced for the quarter of April to June 2023. Interest rate is announced by Government of India on a quarterly basis. This interest is calculated monthly on the lowest daily balance in the account between 5th and last day of the month. Though it is calculated monthly, it is accrued in the account only on yearly basis on 31st March of every year. So the compounding is annually, not monthly. And this interest is accumulated in the account, not paid out. So you don't get a payout every year. And the entire interest income is eligible for 100% tax exemption under Section 10(11) of Income Tax Act. That is the best part. Now look at the tenure. PPF account matures on completion of 15 years from the end of the financial year in which the account was opened. So remember, not 15 years from the date of opening the account, but 15 years from the end of the financial year in which the account was opened. So if you open an account now in April 2023, the account will mature not in April 2038, but on 31st March 2039. 15 years after the end of this financial year 23-24 in which the account is open. On completion of the original tenure of 15 years, you can choose to close the account and withdraw the full amount, or let it continue and extend it for another tenure of 5 years. Now, during this extended period of 5 years, you can continue to deposit the amount or can even choose to just continue the account without any further deposit. So the extension does not have mandatory requirement to annually deposit a minimum amount of 500 rupees. You can just skip it. This extension of 5 years can be done any number of times. So you can keep extending the account if you don't want, that lump sum money for any purpose. Then just keep extending it for 5 years, and then each additional 5 years give you a great compounding effect. Extension for just 5 years from 15 to 20 years will more than double your returns you got in the first 15 years. Isn't it exorbitant? Take an example. Let's say Arjun opens a PPF account at the age of 25 and at 40 it reaches the 15-year closure period. Now at the age of 40 he is most likely not to have any major commitment to right at this point of time. His child's college education or marriage would be another 5-10 years away. His retirement is another 20 years down the line. So he could just extend his PPF for another 5 year with some contribution. So after 20 years, he could make up his mind and extend for another 5 years based on the situation at his age of 45. The returns would be phenomenal as seen in the table on the next slide. Let's look at the exact number in the next slide if you don't believe this. So here, as you see, the first table shows a standard 1,50,000 deposited every year for 15 years. The total deposit is 22.5 lakh and the interest you earn is 18.18 lakh. So your closing balance or the corpus amount at the end of 15 years is 40.68 lakh. But just look at case 2. If you extend the account for another 5 years with deposit of 1.5 lakh every year, you earn additional interest of 18.4 lakh. So your corpus now swells up to 66.58 lakh. So in the first 15 years, you got interest of 18.18. But in next 5 years, you got interest of 18.4, more than double in one third of the time. That's what compounding does to you. And even if you don't deposit any amount for next 5 years, look at case 3. Still you earn extra interest of 16.4 lakhs, over 3 lakh per year, and your corpus would be 57.32. So if you don't need money at the time of PPF maturity, do not withdraw it, just extend it. The compounding really comes after 15 years. You'll see the amount of wealth it can create. Look at case 4 and 5. You extend by another 5 years to 25 years, and your corpus would be over 1 crore. Another 5 years to 30 years, and your corpus would be 1.5 crore. So you are adding 50 lakh in every 5-year cycle. Amazing, isn't it? And even if you don't deposit any money during next 10 years, still your corpus would be over 1.1 crore. So yeah, study this chart carefully and understand how the compounding works and how you can take an informed decision whether to continue, extend the account or not. So the big tip to maximize your interest income returns, deposit the maximum allowed amount of 150,000 rupees between 1st and 5th April of every year. Because as I mentioned earlier, the interest amount is calculated based on the lowest daily balance between 5th and last day of the month. So if you deposit something before 5th of the month, you get interest for that particular month too. Later the deposit or lower the amount, lower will be returns. The common mistake people do is people deposit for tax saving. So they wait till January, March time frame. But if you're depositing, it's better to deposit between 1st to 5th April anyways. So even if you couldn't deposit between 1st to 5th April, do not think that you have missed the date, so we'll deposit close to year end now. Still try to deposit it at the earliest before 5th of next month so that further interest income opportunity loss can be reduced. Now let's talk about how to close, when to close, and what other benefits PPF has. A PPF account can be closed prematurely after the completion of 5 years for specific needs, such as medical treatment for the account holder and dependents, higher education of children. This is permitted. This premature closure is permitted, but with a penalty of 1% reduction in the interest payable on the whole deposit. You can also avail loan against PPF balance. Loan facility is available from third financial year up to the sixth financial year. The maximum tenure of such loan is 36 months and only 25% or less of the total balance available in the account can be availed as loan. Then one withdrawal in a financial year is permissible from the seventh financial year onwards. Maximum withdrawal can be 50% of the balance amount at the end of the fourth year or immediate preceding year, whichever is lower. The best part, the entire maturity amount, either on full term or premature or partial withdrawal, is 100% tax free and not taxed at all. So if need be, like if you're relocating from one place to another place, then you can also transfer your PPF account to another branch of the bank or post office, or switch from bank to post office or from post office to bank. So all that switches and transfers are allowed. So you can conveniently access your PPF account from anywhere you are. Look at the tax benefit. As I mentioned in the previous slides, PPF enjoy triple E tax benefits. The contribution to PPF is eligible for deduction under Section 80C. The interest earned is completely tax free under Section 1011, and the entire withdrawal amount on maturity is also not taxed. Remember, PPF is just one of the many instruments available for investment. You should figure out your financial goals and then follow a properly designed financial plan to achieve your goals with certainty. The bigger question is that if we are investing for a long term, like over 15 years, should we instead go for assets with better returns like equity? I think yes. For such long investment duration, the short-term volatility should not be an excuse to avoid equity. We should invest major chunk of money in assets giving higher returns even if those carry a bit higher risk. However, since PPF deposit has a cap of 1,50,000 per year and currently enjoys completely tax-free status, this much must be deposited in PPF as diversification of your portfolio into a low risk guaranteed income date investment. Look at me. Even though I can take higher risk and I have 95% of my financial assets in equity, I still invest in two PPF accounts. one for myself, one for my minor daughter, because it keeps my money locked so I'm not tempted to withdraw and spend it. It gives me good lump sum tax-free returns whenever I need it after completion of 15, 20, 25 years. I have already enjoyed two cycles of 15 years each, and in the 80s and 90s the returns were much higher at 12%. If I need money in the middle of this 15-year or further 5-year tenure, I have other investment anyways from where I can withdraw. So yeah, I mean, if you like this kind of videos, informative videos, subscribe to our YouTube channel, Happiness Mitra, and share with your family, friends, colleagues, and everyone. And stay tuned for my next video. Thank you.